I'm James Turk. I'm a director of the Gold Money Foundation. I'm here with Ben Davies, co-founder of Hind Capital, a very successful bullion fund manager here in London, England. Ben, good to chat with you. I want to talk a little bit about the markets, but let's start first with the big picture. You know, there are all kinds of distortions and imbalances in the monetary system today. How do you see that? What's the cause of that?
Well, thanks for having me on the Gold Money Foundation videos. Very excited. I think that's a good place to start because, as Chris Powell said of Gas just now in the meeting that we were in, he said, you know, gold is the knowledge of the financial universe, and I think that's absolutely true. But what is gold? We all know now, and we begin to understand, us who are in this field, that gold is money. And not to belabor that point, but it is a very important point. But the system that we're working under now, what we call the Bretton Woods II regime, is actually a fiat currency system, and I think that's a very pernicious system. And what we mean by the Bretton Woods II system is a currency system where the US is centric to it, but currencies peg off it, and particularly China, the rest of Asia by dint of China. And that has created huge imbalances, structural imbalances, as you know. And for me, that unwind, or the potential unwind that we're seeing now as they try to hold it together, is what's causing a lot of the financial difficulties we have today.
So things like the sovereign wealth funds that various countries have, that's a huge imbalance. These huge pools of hot money going from currency to currency, seeking a safe haven or higher yields, that's another imbalance. Those are the types of things that you're talking about. Yeah,
it's along those lines. I mean, let's sort of go back to real basics and let's talk about vendor financing, which is about China being mercantilistic and exporting to the US and the rest of the world, and Europe in particular. But what do they do with the dollars that they receive? They've got a fixed or a semi-fixed exchange rate. And they want to maintain that because they're wanting to keep their competitive advantage by having a devalued or a undervalued currency, and that's what they have currently.
To keep their export industry moving,
absolutely,
taking advantage of that undervalued currency.
Absolutely. But what does that actually entail? You get a flow of dollars back into China, but obviously they have to deal with those dollars, so they have to sell their own currency in order to maintain the peg. Now this leads to a huge FX accumulation, which we've seen go from probably 500 billion to 3 trillion in China alone. In fact, currency reserves have gone from 500 billion to 11 trillion in a 9-year period. Now you tell me that's a sign of a stable financial system. Clearly not. You don't have that kind of level of foreign exchange reserves. So for me now, we're in a situation where the QE3, or sorry, the QE2, I'm running ahead of myself.
You're anticipating the future.
The QE3. The QE1, the QE2 that we've seen has just created more FX accumulation, which they're having to deal with because it's now starting to create inflation. And they're struggling to hold that peg. They can't keep issuing currency. So we're finding a situation where inflation is rising globally. But probably rewind, but what's interesting is before, the reason why this system didn't appear to be so inflationary is because obviously China had a huge labor pool. And as we moved from an agrarian economy into an urbanized environment, and as they moved from sort of a lower income into a sort of middle class environment, what we've seen is wages demands have risen. In fact, actually, China has effectively said, look, we realize perhaps the game is up with this currency system and we need some domestic growth, and we can't completely rely on mercantile growth. That's what I think is trying to happen, but they want to let this happen over a gradual period of time, but this is where the pressures are growing.
But they're not adjusting the exchange rate in order to allow the adjustment, and its consequence are going to continue to build these huge imbalances.
Well, they are, but very, very slowly.
But not fast enough, because the reserves are building rapidly.
Absolutely, and that's a function of the quantitative easing, the liquidity that we've seen in the system. It's happening at a far greater rate, which is why we're coming to a zenith point, a tipping point, if you like. So I think there's two ways of looking at the world now. Either we're going to burst this fiat bubble, this currency accumulation, and we're going to have or we're going to actually have Asian economies actually allow their currencies to appreciate, allow those structural imbalances, i.e. the current account surplus, to move towards the deficit as they go more towards domestic demand. Personally, with what we've just seen in the last couple of days, we've seen that beggar thy neighbour behaviour already beginning in the markets again. Look at Japan, look at the Swiss intervening in the market. These are all a function of the dollar distortion, and they're having to react because they've got too strong a currency now for their export market, which is the only place that they seem to be able to get growth at the moment.